episode of the Practical Wealth Show, and I have my friend and mentor, Mr. Joe Pantozzi, from Alpha Omega Wealth, who was, I would say, one of the godfathers of this thing we call infinite banking, and knew Nelson, trained with him personally, and so he's, I've been blessed to work with him for probably the last 4 years, and my knowledge has grown exponentially. And so a lot of times, y'all, I interview all these people but I do this, okay, infinite banking. So, you can call me. It's like, I don't know anybody that knows more about this than me. If I don't know it, he knows it, right? And so he's my brain trust. So, Joe, welcome to the show.
Good morning. Thank you so much. Yeah, and if you don't know it and I don't know it, we probably have a friend around the block who knows it, who's part of our circle.
Because it's a very small community. There's a lot of people that say they do it, but
yeah,
that's when I start listening to them, they say things, they don't really get it. Okay. And people have to read the book, say, oh, I get it. Well, how many times you read the book? Once. You don't get it. All right. If you start asking me stuff like, what's the interest rate on the policy, right? You don't get it. Okay, because I had to read somebody from the book, and this is not about rates of return. It's not about investing. It's about the fact you finance everything you buy. And so I want to kind of go back to basics today to get people to understand, what is becoming your own banker, infinite banking, private reserve, whatever you want to call it, and then what's the problem, and then we'll just whatever little pet peeve I want to get out, I'm going to ask you on air.
Good. I like it.
So you want to give me a little background about, because you've been on a couple of times, but not in a couple of years. So give me a little background about you, and then let's have some fun.
Sure. Thank you. I appreciate it. I enjoy rubbing elbows with you and sharing ideas. And every time I visit with you, you always call me mentor, and you're so honoring to me. And every time I talk to you, Curtis, I learn something. And I'll bet I take as many notes about what you say to me as you take what I say to you. But I've been around this business for a long time, and that doesn't mean anything unless you continually learn and build on and improve what you learned 50 years ago. Because the things I learned 50 years ago allowed me to survive, and that's all they did. Right. And the people who are listening to this do not want to know how to survive, because we're Americans and we pretty much know how to survive.
Right.
Paycheck to paycheck. And that's what many people do. But what we're interested in doing, and the phrase I use is financial literacy, we're interested in elevating the level of financial literacy for as many people as want to listen.
Right.
And as many people as not only want to listen, but want to implement. Right. And maybe number 3, I want to listen, I want to implement, and then I want to drag my kids kicking and screaming into the 22nd century and say, if you don't understand how to control the banking function will control you.
That's right.
And so infinite banking concept is all about you controlling the banking function, getting a hold of it, finding out what it even means. Why in the world do I care that $1 trillion bank does this and this and this with my money? I've got no connection with them whatsoever. I don't even have a clue about what $1 trillion bank does. The only difference between what $1 trillion bank does and what I do in my household is a bunch of zeros. Right. But the concepts are the same that you can use to build wealth. I mean, there is literally nothing new under the sun. There's knowledge and information and data and wisdom that we haven't learned yet. It's not that it's not out there, it's there. Other people using it. And how many people have said to you, Curtis, oh, this is so great. This makes perfect common sense. This is so logical. Anybody can understand this. Why didn't I know about this 30 years ago?
Right.
Now, here's number one example. I got in the business when I was 23 years old, in 1976. I was in the business for 25 years, did fairly well. I did well from the world's perspective. And I was quasi successful from the world's perspective. And then I met Nelson Nash in 2001, and he turned over my Apple cart. He says, "Hey, Joe, I wish I could repeat that beautiful accent of his. son, you really understand how money works? I don't know, Nelson. I'm a CLU and a CHFC, and I'm a licensed registered representative. I understand the stock market. Sure, if you understand the stock market, or you say you do, you probably have somebody in the back office who understands it, and they help you, right? As I help my clients. But
Right.
I was in business for 25 years. I thought I understood money, how it worked, and then Nelson opened up my life to me. So, for example, you have a house. What's your biggest asset? Well, Nelson, it's my house. Well, no, it's not. Your biggest asset is your ability to earn. Your ability to earn. And so, how much money are you putting into your house? Well, several $1,000s a month, et cetera. And how much money are you putting into your life insurance program? Less than that. And he says, so then, why are you putting more money into a less valuable asset, which is your income ability? And he opened up the idea of banking to me. He opened up the idea of controlling the banking function, right? And before we started recording, we were talking about Einstein, and I've read about him over the years, and some people know the history. Basically, Einstein was probably one of the smartest mathematicians who ever lived, right? He came up with different mathematical formulas, some of which I could spout off, but I have no idea what they mean. I know that Einstein was invited to become the first president of the nation of Israel when Israel became a new nation, and he wasn't an Israeli citizen, right? Israel became a country in 1948. He was invited to be president, and I believe he died in 1952. He said no, thank you, but he was honored. I know that about him. I know that he was an honorable man. I know he had integrity. I know he was a math genius, and I also know that he died broke. Wait, I'm out. He died broke. So I've been saying for a long time, there's math, and then there's money.
Right.
And I'm not very good at math, and that's why I have things like this, right? We have calculators, we have programs, we have apps that we can use, but that's got little to do with the skill and the wisdom involved in building wealth and holding on to wealth. And as you alluded to earlier, many people are out there, forgive the use of this phrase, hawking some kind of product, saying that the product is going to solve the problem of banking. And if you use this product, you're going to instantaneously learn how to become your own banker. And your world is just going to go, it's going to go skyrocketing, and your wealth is going to increase, and your children are going to be better looking, and they're going to get A+ and all tests just because you buy this product. Great. I got some workout equipment downstairs in my basement, and every so often I go down and dust it, and it does not give me better abs. Okay, I got products.
Right. That's good analogy.
But what gives us the better results is making a commitment to ourselves, and we're saying, I'm going to learn to absorb and to try to strive toward greater financial literacy in myself, my family, and my kids and my grandkids, so that they could do things different, right? And Robert, speaking of the word different, Robert Kiyosaki said, I'm going to shut up in a minute. Give me 30 seconds. Robert Kiyosaki says, rich people aren't rich because they're doing things differently than other people. And he calls savers losers, right? We've talked about that, and we can talk about that again. He says, rich people aren't doing things differently than losers and savers and other people. Rich people are doing things exactly the opposite. So take a look at what you're doing and get a coach, call Curtis, call his team, call me, right? Get with us anyway, and figure out what's the opposite I can do.
Right.
Right. So people are putting money in the 401k because their neighbors putting money in the 401k. Well, how are your investments doing? I don't know. I just kind of pick the investments in 401k based on how the names sound. If they sound good, if it's a cool, attractive, sexy name, I pick that one. And I hope it does well. Then I check my statement a year later. Do you really check your statement a year later? You see what your rate of return was? Really? That's great. How much money have you put into your 401k? Oh, I don't know how much I put in, but I know what I have. Oh, so you really don't know whether you got any rate of return whatsoever, right? And so going back to basics is figuring out what were the steps that I glossed over, that I ignored in trying to build a financial kingdom. And one of those steps is, why would I even get involved in infinite banking or the infinite banking concept if I didn't make a connection between how banks work, how money works, and my personal life.
Right.
And people say to me, well, why don't banks tell us this? Why haven't we learned this in grade school, in high school, in college? Well, number one, if a bank's primary motivation is in getting your money and getting it into their banks and their accounts so that they could use it and make profits for themselves, didn't that just tell you the answer? Why they're not educating you on money? Because their interest is not in educating you. Their interest is in taking your money and using it and giving you paltry interest back on your money. As we say, giving you one dimension of money. Your money sits, it earns interest if it does, 1/10%, 1/20%, 1/5%, and the bank goes and makes 20 times what they paid us. So if their interest is in taking our money, maybe we should look under the hood and find out, well, what is it that banks do that I can do and cut out the middleman? I mean, it can be that simple. Right. I'm going to take
People overcomplicate it. And, again, you got people talking about this product and that product. Well, this works better. But it's really simple. It's, we say that you can be a customer of the bank or you can be the bank, right? This is what we're talking about. Our mutual friend Ryan Griggs is like, you said this one time to me. I said, I specialize in helping people capitalize their financial situation, something like that. I'm stealing. I've been trying to remember what you said. And but I was just showing before we jumped on the call, I was working with a client and I said, look, there's a difference between capitalizing and investing, right? And so investing is to forfeit control of money in order to generate either income through cash flow or capital gains, but eventually you have to liquidate it to use it, and there's no guarantees. Whereas banking and talking about controlling the money that flows through your life, well, you want to accumulate money, financial value, in order to leverage that financial value to acquire wealth. What is wealth? Or to acquire what I call assets. What is an asset? Something that puts money in your pocket, right? You want to buy or build cash flowing access, but you want to retain control of the money too, right? And so liquidation is not optional. And it would be great if you had some guarantees, some certainty on the money. And that's like, a lot of people want to investing. Like, if I tell people, look, if there's 5 rules of money, investing in my mind is number 5. It's not number 1. And that's what people don't get, is number 5, because this thing, you need to save, you need to capitalize your position, you need to make sure you have protection, you need to make sure your estate stuff is, and you need to have 6 to 12 months of liquidity or more. And now you've got some capital, because what does Nelson say? If you have money, opportunities will find you. You don't even have to go look. You just got to know the difference between an asset and a liability. Going back to Kiyosaki, and that's all I want people to do. And so let's talk about, before we go back into banking, let's talk about, in your opinion, the problem most Americans are having, that if they understood, because Nelson said, if you don't understand the problem, the solution just don't matter, right? And what's the problem? And I'll say this: banking is a process. So Joe and I are going to talk about the process of banking and the product. See, because people think the product and the process are the same thing. And so you don't need necessarily an insurance policy to be the bank. It makes it better, but that's a product that we facilitate, properly structured, dividend paying, whole life insurance with a mutual company, to be very specific. Okay. So now I'm just making that statement, Joe. Haven't we just narrowed the field down from maybe 2,000 companies to about 10 or 15?
Yeah, maybe, yeah, a couple of dozen.
Yeah.
That's about it. And we're speaking about the majority never being right about anything,
Right.
right? More than half, more than 50% of Americans are buying life insurance that's not going to give them a return.
Right.
And I'm sorry that that might be a surprise to most people. But if somebody buys a term life insurance, which by the way, I own term life insurance today, I'm 70 years old, and I have a schedule to convert the remaining relatively small piece of term insurance, still over $1 million, still a relatively small piece for me, converting that in the next year or two, according to a schedule. But if you have term insurance and you take it out to its logical term, which is normally 10 years, could be 20, could be 30, but if it's 10 years, you're saying, well, I'm going to cover myself right now and worry about making it, extending it later. Well, what really happens at the end of 10 years? I had a cheap policy. I go out and get examined to get another cheap policy. And now I'm 10 years older. Now I have to take a physical again. And what do? I shop for cheap. I don't know. I don't care what kind of car you drive. I don't care what kind of truck you drive. My primary motivation, my primary measure when I'm going to buy a vehicle is not cheap. Yeah, I absolutely want to get from point A, point B. I put my grandchildren in the back seat of my truck. I want to make sure that those kids are as safe as they can possibly be in any event, under any circumstances, snow, rain, you name it. Okay. My primary factor is not cheap. Right? You want to buy quality. You want to buy a quality house. You want to go to quality school. You want quality daycare. You want quality worker in your house, right? Taking care of your house, painting, whatever. We buy quality. If you buy a watch, I have a couple of watches, not wearing one today. You want to buy a watch, you want to buy a decent watch. All of a sudden, well, I'm going to buy the cheapest life insurance I can get because you know what? The cheapest life insurance and the most expensive life insurance will absolutely pay tomorrow if you die, if you graduate tomorrow. But 99 point something percent of people who buy term insurance don't die with that policy. All right. So we're talking about buying quality. And I'm going to put variable life, universal life, index universal life in the same bucket, same basket. Most people buy that stuff because they look at the short term.
Right.
And the short term is we have just a ton of insurance company expenses that we're going to deduct from your premium before we invest $1 or give you a dollar's worth of return on your net money after expenses. And oh, by the way, when you get older, those mortality charges, those life insurance charges will go up, not may go up, will go up based on the history of those products. The history of those products only goes back to the late 70s or 1980. We're talking about 40 years. 40 years worth of history versus 250 years of whole life, that boring, stable, conservative, low rate of return, right?
Right.
But with those products, they look glitzy and glamoury and shiny because they're theorizing some lofty rate of return that's going to outpace the rate of return of a whole life policy. But you mentioned it early on. When you buy a life insurance policy, if it's part of a banking model, it's part of your capital base. Your life insurance is not going to make you wealthy. I don't care if you die tomorrow. It's not going to make your kids wealthy if they're not trained how to control money and how to manage money and steward money.
Right. Your
life insurance is part of your bond portfolio. But where are you going to make your money? And we can disagree on this. Well, maybe somebody wants to invest in the stock market. Fine. That's where you can make your real money, if you think. Or you're going to invest in a business or in a serial entrepreneurial enterprise where you own and operate multiple businesses or multiple kinds of businesses. Or you're going to invest in real estate for cash flow. Okay. Just a little side here. I know people who are in real estate, who are real estate professionals. And what they've done for years and years and years is they love 1035s. It's because they buy a property and it grows and appreciates for a while. Then they 1035 it, they move the equity and sell it. They move the equity to the new property. Okay, great. What did the 1035 accomplish? I made my capital gains tax deferred. Okay, great. Are you moving into a smaller property or a bigger property? Well, always a bigger property. Great. Then your tax is larger, but deferred. And I can 1035 and 1035 and 1035, and maybe I'll sell something along the way. And all I'm really doing is supporting a bigger and bigger lifestyle.
Mm-hmm.
Then you have a different kind of a real estate investor who doesn't invest for 1035. They don't build a real estate portfolio for 1035. They build a real estate portfolio primarily for cash flow. And some people will say, when I buy a property, I never let it go because rents, generally speaking, don't go down. I don't care. I don't care if inflation is 9%. I don't care what happens. Rents stay the same or they go up. And so I'm going to build a real estate portfolio and build cash flow. So what the infinite banking concept is about is learning how to control a capital base, as you say, own the capital base, not rent the capital base.
Mm-hmm.
So that now you're making money if it's real estate or your serial businesses. You're making money in your cash flow operations, you're making money in your capital assets, but you're also getting some growth on that capital base. Because if you're not using your own and owning your capital base, you're renting your capital base. You're either renting it from a lender, from a finance company, from a bank. They're lending you money at an interest rate. You give the principal back to them whenever it's scheduled to give back to them, to pay back to them, and an interest rate. And what do you have at the end of the day? Well, you have whatever you bought with it, right? But if you control the capital base, you're going to get the continuing growth over years and decades and eons of having a capital base. So you have asset number one, it's only your capital, it's only a bond portfolio, it's earning, but it's doing multiple uses because you can collateralize, you can borrow against it. And now some people will say, well, yeah, I invest in real estate. How do you do that? Well, I own a home. No. Your home is not an investment. Your home is your home.
Right.
You're going to have maintenance and taxes and catastrophic events. Your chimney falls down or something, or your house gets struck by lightning. You have a minor fire. You have a flood. Whatever. You're going to have maintenance and repairs and taxes and beautification. You can upgrade, build a pool, put a fence around your house. And when you do the math over a long period of time, you didn't make any money in your house, and I don't care if you did. Your house is not for investment. Your house is where you raise your family. It's where you have your comfort. If you want to build real estate for cash flow, you buy more real estate.
Right. And the thing is, when we talk about banking, people say, well, I don't know if this, should I be, they'll say to me, well, I just want to talk about it. I want to see if I should be doing this. And what I'll tell them, Joe, is that you're already doing this. Okay. You are already banking. All of your rents, all of your paychecks go into somebody's bank. Okay. Are you getting any profits? Are you getting any dividends? Are you getting any, so you're renting the banking function, but you don't control it. So banking is about, creating a pool of capital that you control that can move at cost to meet some needs you have. So if you can create, what is that in that book, The Case for IBC, an alternative bank while you're using your part of your revenue from your business to create a pool of capital, and then you can systematically buy back, major capital purchases. I use mine for taxes. You can all the money that you're giving away, that you're liquidating, but you have to focus on cash flow. So the people that work with us, especially, with Practical Wealth, I tell people, look, the goal, people that work with me, their goal is work optional income, which is cash flow, right? So we have a little newsletter we call the Cash Flownaire, right? And so we want you to, to focus on being a cash flow. And then what I'll talk about is there's 4 asset classes, right? So this is what's going to make you rich. The policy, so when you hear people talk about, I can do this with the the life insurance stuff, those are illustrations, right? Ain't nothing in the product guaranteed. Okay. They've transferred all the risk to you. That's why people are selling it, because they look at these illustrations and they pay them more to sell it, and it's more profitable for the company. So you have to understand how it works. And a lot of people that are in the insurance business, I'm going to go back to the process, but this is a pet peeve of mine. They only been here 2 minutes, right? They might be making a lot of money, but actuarially, they don't understand what's going on in the policy. I have a video on it called The Truth. It's called The Truth About IUL on my YouTube channel, but I'm going to change it to the understanding insurance, because I don't want to like bash something. And I go over, here's how term works, here's how whole life works, here's how universal life works, and try to keep it, me and my friend Kyle Christian, I try to keep it, he does a better job than me, less unbiased, because I'm not unbiased. But I think we do a good job of breaking it down.
Everybody has a bias. Everyone on the planet has a bias. What I suggest is that when you as a client are going to pick an advisor, you get to understand their bias right out of the gate.
Yes.
Now, my bias is guarantees.
Yes,
so
mine too.
My house insurance, as an example. Well, if there's a rainstorm and a tree happens to fall against my house, do I have to call the insurance agent up and say, listen, I had a claim, a tree fell into my house, probably didn't do a lot of damage, maybe a couple thousand. Well, let me see what the market did last week and find out how much of that claim we're going to cover. Wait a minute. No. I bought a policy with the understanding that you're going to guarantee that I'm covered no matter what happens, if it's a covered loss, right? And so I just wish that people who are selling these variable and index products and passing them off as life insurance, which, by the way, life insurance companies pass them off as life insurance too. I wish they would just be transparent about how the product works. That's all I ask. Because if you talk to people who have bought a product in the past and you say, have you looked at the page that shows your increasing insurance cost? Well, no, my client policy doesn't have that, because my policy is a fixed premium. My premium is never going to go up. Okay, would you mind if we took a look at that? Would you mind if I showed you in your policy, we're talking about indexed or universal or variable. Would you mind if I showed you in your policy where your premiums are going to go up? Okay, now the agent would absolutely say, well, that schedule may happen. No, actually, that's not true. The insurance costs inside one of the policies absolutely does go up.
Right.
What that schedule shows you is what's the worst case scenario that they might go up to. I just want to know that you're aware of it.
Right.
So, okay, but it's not likely to happen. Well, are you buying a policy that it's likely to pay if something happens to you? Or do you want to buy a policy that absolutely pays? There's no ifs, ands, or buts. After the 2-year suicide clause is gone, the policy is going to pay for any cause, period. Right? They used to sell policies with a war clause 50 years ago, 75 years ago. They don't have a war clause anymore. I mean, there's virtually no reason why the policy won't pay. As long as you pay your premium, as long as the policy is in force, the policy is guaranteed. So the variable universal index are missing 3 guarantees that the whole life policy contains. And we haven't even talked about capitalization, getting into that, but guaranteed premium in writing in the contract, guaranteed cash value schedule in dollars. That's a big deal. We talked about Einstein and the difference between math and money.
Right.
I read my friend's schedule the other day, and the schedule for his increasing premiums, the schedule and the formula that you have to figure out was so complex, I could not guarantee it my math was right. Now, if a planner with 45 years of experience can't guarantee you that the math is right on that variable policy, what do you think the chances that you can figure it out? Guaranteed premium, guaranteed schedule of dollars, guaranteed death benefit. Okay, if you want a policy that is going to be in effect one day after you're gone, no matter what age that is, if it's 110 years old, then a universal life variable index will not do that. It's just simple. So let's get back to the need for capitalization. What Ryan Griggs says is stay capitalized. Stay capitalized. Nelson Nash says, Don't be afraid to capitalize. Somebody else said, the number one reason why the lion's share of businesses fail in this country is one reason only. It's not bad management. It's not bad marketing. It's not bad product. It's lack of capitalization. Right? When individuals and families declare bankruptcy, what was their problem? Well, I didn't have enough money to pay my bills. Okay, you were undercapitalized. And the opposite side of that coin is you were probably overcommitted to the liabilities in your life. You were overcommitted to those 4 BMWs in your driveway. Listen, I don't care if you have 20 BMWs in your driveway, as long as your cash flow and your revenue schedule and your business permits that. I'm not here to tell how people how to live. I'm not here to have you decrease your lifestyle, because I'm a poster child for that. At a certain point in my life, a long time ago, I sat down with my wife and I said, listen, we can either constrict our spending and constrict our expenses and constrict our lifestyle, or I can increase my income. Because you can only constrict your lifestyle
so much, right? You can't get bluff from turn. So we want you to I want you to enjoy your life and focus on expanding your means. Right. And how do you make money? Money follows value, which means you've got to create more value in the marketplace. I believe you need to have a lifestyle ceiling, right? Because one of the human problems in the book, the Parkinson's law, is always in effect, because you can spend, if you gave me $1 million, I guarantee you I could spend that in a few months, with all the stuff that I could, my what I call my lifestyle desires. I have to, so expenses rise to meet income. And so, you will spend it, right? So you have to, at the core, Joe, one of the things I tell people is I think it's a system of money management. We're using a properly structured policies, but you have to be a good steward. You have to manage your cash flow. You have to be a prudent, like banks are obligated to the prudent man rule. Like you have to make sure that, they don't really, people say, well, banks invest. Banks don't, well, I don't know if they're adhering to that or not, but as he makes a face at me, but they don't invest, right? They loan money to people. And because like, for example, a real estate investor thinks the asset or their asset is the house or the property or the apartment building or that they're buying. But the bank looks at, they're in the money business, you're in the real estate business, and they see the asset as their note because they're getting back interest payments, and your house is their collateral, right? And see, what I try to do is, look, you need to kind of marry into the family, so to speak, and learn how to be both, right? You got to learn how to, what if you could be the investor and control the banking system so you got the profit, you had uninterrupted compounding, you got back the money. That's what we're talking about. And see, so that's more a philosophy and a mindset. So we've talked about the product, but you've got to understand the process and what you're trying to do, which is be in control of the money that flows through your life. Because our whole thing is set up to make everybody else rich. If you just follow the rules of the financial institutions that they teach you, one of the things we both say is, listen, you can do what the banks do or the institutions do, or you can do what they tell you to do, or you can do what they actually do.
You can do what I do or do what I say.
Right. And so what they say makes them rich. It don't make you rich. Right. And so I always tell people, Joe, here's the 4 rules of the financial institution. They want your money. They want it on a regular basis. Right. They want you to put money in their bank. They want it on a regular basis. They want you to keep it there as long as possible. And they never really want to give it back. Right. So you want cash flow. So y'all whole game plan are, y'all have different agendas, right? You need your money and they don't want to give it back to you. So
one of the things that we say this all the time, and I hope people get this and think about it, and we'll try to go deeper, right, on what I'm about to say. If you want to build wealth, you want to follow the people who are building wealth, right? You want to follow rich people, Fortune 500 companies, how they manage their finances, and banks. Rich people, Fortune 500 companies, and banks. And one of the things that, the one thing that they all have in common is they all build up elements of long-term tax-free wealth, right? So Bruce Etherington, my great friend and mentor in Toronto, Canada, says, in order to build wealth, you need capital,
Mm-hmm.
you need rate of return, you need time, and you need freedom from tax. Now, here's the problem. Here's where people depart from the established wisdom that rich people in banks and Fortune 500 companies lay out. What they continually do is they continually increase their capital base. Okay. And now you look at a person and you say, what's your capital base look like? Well, you know, we had an issue, we had a problem, we had our kid wound up taking 6 years to graduate college instead of 4. Had a medical issue. My spouse was unemployed for a while. I was whatever it is. Okay, you've been working for 25 years. How much do you have in the bank?
Mm-hmm.
Well, I have $50,000 in my 401k. Fine. How much do you have in the bank? Money that you control. Your 401k is controlled by somebody else. How much do you have in the bank? And if I buy this policy to use it as part of my capital base, how long do I have to fund it? See, that's the problem with human beings. We don't want to commit to long-term funding, but we want long-term financial security, don't we?
Right.
So a client says to me, well, I don't know, I might be too old to start this banking thing. How old are you? I'm 46. Really? Okay.
That's hilarious.
So a client's 60 years old, 70 years old, they say, am I too old to start this banking thing for myself, my family, my grandkids, my great-grandkids? And I say, you should only not be concerned about controlling your capital base, controlling the banking function, if you plan on anytime soon stopping the control of your own finances. If you plan on giving up control to somebody else because you're about to lose your cognition, you're about to lose your mental capacity, fine, delegate it to somebody else. But most likely that money manager understands the need for capitalization continually, not just for a short period of time. Well, I don't want to commit to this high premium, but that same person is going to get to age 65 or 70 and say, wow, gee, I thought I was killing a bear because I built up $200,000 in my 401k. That's fantastic. What's your withdrawal rate going to be? Mm-hmm. Well, I'm probably going to take out, 10% a year. And I'm going to use that to supplement my Social Security, and I should be fine. Yeah, you will absolutely be fine for 7 or 8 years. Well, how does that? Well, let's do the math another day and I'll show you. Because the stock market, if that's what you're in, is not going to give you 10% every single year.
Right.
It might give you 20% next year. It might give you a negative 20% the year after. And I'm a registered securities representative, and I have clients with money in the market. I'm not talking about that. We're talking about your seed money, your capital, the money that you don't want to put into a volatile situation. Like Curtis said, you protect first, then you save, then you invest, and then you speculate. Right. Most people are going to look for the quick deal. Hey, my friend heard about this penny stock I should buy. We're going to make $1 billion on it. Okay, great. How much you got in savings? Well, I got $20,000, but I'm going to buy that thing. Really? You're going to take your savings and speculate with it? So what happened to your security blanket if something happened in an emergency basis? You're confusing things. Your capital base should continually be fed. That's what you feed first. And then you outreach into other things that you want to put money in. And that's your choice. Our whole role is to maintain a capital base, continually improve it, protect everything in your world, and help you buy more of what you want to buy. I'm not here to tell you to buy stocks, don't buy stocks. Buy real estate, don't buy real estate. Buy Krispy Kreme, don't buy Krispy Kreme. Buildings, gas stations, dry cleaners. I'm not here to tell you not to do any of that stuff. I'm here to help you buy more.
Right.
In order to do that, you have to capitalize more. Think like a rich person. Don't think like a person with a scarcity mentality.
Mm-hmm. Tell them capitalize means, all right, so I've got X amount of revenue coming in. And so you need to decide how much of that you're going to keep, that you're going to underconsume and put that money and build your capital base. I want you to break down what capitalization means from a budgetary standpoint. I want them to be clear on what we mean when we say capitalize.
Okay, so you're talking to a Kool-Aid drinker, right? With a bias.
Right.
My bias is I fund my whole life policies first before I do anything of a capital or venture or investment nature, right? And I've bought property in Central America. I bought beachfront property. I've started and sold businesses, right? And like I said, when I met Nelson, I thought I was killing a bear because I was paying $1,500 a month for life insurance. $1,500 a month is a lot of money for some people. It was a lot of money for me back then, but that's what I was committed to because that was my protection device to take care of me and my family and my kids at the time. And now I have grandkids, but it also was building up equity for me. And then over time, as I continued to understand, I should be investing in my number one asset, which is me. And I should be buying all the life insurance that any good company will give me. So every so often I check and I say, let me look at my income and see if they'll still give me more. A couple of years ago at age 67, I called up an underwriter and said, listen, my income's gone up. I've got a bunch of millions of dollars. What does it look like for you? He says, well, you can qualify for another $1.1 million. I said, give it to me. All I'm doing is increasing my capital base. I'm not worried about what the policy is earning. You know what I'm concerned about? Putting money in. John Savage, great mentor and financial giant in our business, said, your wealth plan, your riches, your net worth has nothing to do with the rate of return of the instrument you put the money in. Your wealth has to do with the systematic methodology of putting the money in. So what if I put $10,000 a year in for the next 10 years into something, and the market, whatever market you want to talk about, gives me zero rate of return, zero? Am I going to say, well, I'm not going to invest any money in the next 10 years because I'm not earning anything? Really? If I invest in a zero market next 10 years and I put 10,000 a year, 10 years from now, I've got $100,000. And I'm going to be way ahead of the person who's waiting for some market to give them some rate of return. I'm not looking for anybody to give me rate of return. I create my own rate of return with my activities and my behavior.
Yeah, that's correct. And so one of the things that we talked about on another talk was because I'm thinking I've got to rethink how I do that. So I'll start people, because this is not what you said, right? And I remember talking to Nelson, like on the equipment financing on and so the book's birth, because Nelson owed like $500,000 or more, went from 8% to like 23%, right? So most of us would, if they had that, they would, I gotta stop this insurance. Somebody called me there, say, look, this premium is the problem. It's not, it's the solution, not the problem. And so this is not what you stop, because they're, and I'll take them back to the book, Think Long Range. You've had this thing like a year, all right? And he just said, look, he didn't say like, I got to cut back, I got to do this and that. He says, I need more policies. I need to get my premium, meaning the money, because in his mind, premium was saving, right? Y'all still think of it as a cost. And he talks about, Joe said somewhere in talk premium deposit. And so he said, look, I got to pay $100,000 in premium. I mean, I need to save $100,000 a year. He rearranged his finances and he grew his business because he started teaching people what he was doing. And he was able to, within 8 years, 11 years, have enough money in his policies to now buy back that debt, take a policy loan, pay those people off. And then he didn't try to pay it all right back. He had a place to store windfalls, right? And so people don't get that. All right, you think in terms of, if I'm making 50 grand a month, you really want to put all 50,000 into the policy first.
I want to put my money through my bank first. And I want to minimize to zero, if possible, the amount of money that I put through other people's banks. because it's either going to go through my bank or somebody else's bank, right?
Mhm.
Now, here's a great example, and we haven't touched on this. Maybe we could expand another day. Where would you like to borrow money? I'd like to borrow money where I could get it for zero or as close to zero as possible.
Mhm.
Okay, so when you borrow from an outside bank and from a lender, finance company, SBA loan, whatever, you're going to get the market rate, and you're going to pay the principal back at some schedule and the interest back. And at the end of the day, they have all the money again, and you have the asset that you invested in.
Mhm.
Now, a client comes to me and says, listen, I'm going to have to take a loan to expand my business. And I'm pretty sure that I don't have all the money that I could possibly get in my life insurance. So let's say they've got a mature policy and they have a couple of $100,000 available in cash value in their policies. They can take a loan against that at 4 or 5%. Now they're going to take some finance loan, line of credit, et cetera, at 6 or 7 or 8% or greater, right? In today's economy, interest rates are pretty low. They're going up.
Mhm.
Client says to me, now I realize, Joe, that if I had $500,000 in my life insurance, I could have borrowed the whole nut that I needed from against the life insurance. And what would my payment have been? Your payment would have been interest only, first of all. So let's say 5% on $500,000 is $2,000 a month, interest only. You control if and when you pay principal back, but maybe you want to continue expanding. So you're going to take that principal you would have paid back to the loan and keep on buying other businesses, other stuff, expanding your kingdom. So now you've got a totally controllable interest rate because that interest rate will never go up, right? 3 months ago, 4 months ago, mortgage rates were 3%. I have a 3% loan on my house, 3%, right? Now, interest rates have gone up quite a bit by comparison. Now they're 5.25. They're going to continue to go up some more. And then when interest rates are 3% for a mortgage, people are not excited about taking a 4 or 5% loan against their life insurance. What's going to happen when the reverse happens? What's going to happen when commercial interest rates are 7, 8, 9, 10, 12%? Now they're going to come back and say, boy, I sure wish I had capitalized my policies because then I'd have access to the money. Are interest rates going to go one way forever? Either up or down? Of course not. Interest rates are going to go up and down.
Right.
But you can have access to a line of credit that you establish, that you control, and you can tell the lender, which is the insurance company, when and if you ever pay principal back. If I keep that loan outstanding until I'm 90 and then I graduate, guess what happens? The insurance company says to my wife, you know, I'm sorry that Joe had $1 million life insurance loan. And so we're not going to be able to give you the $10 million that we promised you because he's already borrowed $1 million. So if you don't mind, we're going to send you a check for $9 million. And she's going to say, I think I'll be okay with that.
Right. Right.
And we're talking about reality. We're not talking about short term. A life insurance policy, just like your finances, just like your life, is designed to go your whole life, your entire life. I don't want my life insurance portfolio to dissipate and disappear and get annihilated when I'm 75 years old because the costs have gone through the roof.
So part of the work is, and Joe, I appreciate your time because I know you got to go, is to, one of the things that Nelson said is, and this is what we work to help people do. You've got to rearrange your finances so that I call it the process, what I teach is you have to deconstruct your personal economy, because right now it's there to serve everybody but you, the banks, the governments, the big companies, corporations, and then reconstruct it so that you put yourself in control of the majority of the money. Yeah. So that could be minimizing taxation, because see, most wealth is lost, one, by how people manage cash flow, and two, through what we call, Joe, in our system, wealth transfers, right? How you pay your mortgages, taxes, how you fund retirement plans, how you pay for educational expenses, and how you pay for major capital purchases, right? Which I define as anything you can't pay for in full within your monthly cash flow, and you have to finance it using somebody else's bank. There's more money lost in those 6 things I just named than you'll ever make trying to pick winning investments. So you have to, if you want to create maximum wealth, you want to create maximum efficiency first, right? And now from that capital base, you can do all the other stuff that you want to do. Real estate, the 4 asset classes: business, real estate, paper, and commodities, whatever you like, right? Because investing is not about buying something. It's more about becoming something, right? Because y'all, you know what I mean? You got to, it's become, then do, then have. And so most people abdicate the being because transformation is hard, right? It takes work. You have to become a real estate investor. You have to become a good business person. But what we're taught is, well, you don't have to worry about that stuff. Just give your money to us and we'll take care of it for you. Well, where has abdicating responsibility worked out well in any other area of your life? Oh, I'm gonna send my kids to boarding school. I'm not gonna raise my, that kind of stuff. You have to control it. You have to, I parent, right? Control, right? And so you want freedom. See, freedom is 2 parts of freedom. It's freedom with responsibility. So, but everybody wants freedom, but they don't want no responsibility. And so one of the things, and you've studied with Dan Sullivan, he says, listen, if you decide you want to be in business, he says the 2 entrepreneurial decisions, right, are: 1, you have to, what did he say? He says you have to, the one decision is that you are going to be 100% responsible for your well-being. And you don't deserve any money, I could be butchering this, unless you create value in the marketplace first, right? So you have to, decide that you're going to live in the entrepreneur world, or even if you have a job, like you have to be in control and decide that, okay, if it's up to if it's to be, is up to me. And so the people that work with us, they want control of their life, and so in our system, Joe, excuse the language, we call that getting to a position of FU, and which is passive income greater than your expenses. But you must control the banking function to get to FU, and
no way around it.
No way around it. You have to control your money. You have to want to be in control of your money. If you don't, then call your local Dave Ramsey person or your cousin in Primerica. Then they're a good place for you to go. But if you want control, if you want control, because you don't want control, don't call us. Okay, because that's and so that's my negative takeaway, right? Don't call me if you don't want to think about your money. Joe, any now? So we're gonna make this a series, guys, because this was awesome. And I thank you so much for your time. Any you want to take us home? Any pearls of wisdom you want to leave with?
We always leave more pearls on the table,
right? I know.
I mean, there's so many points that we should talk about that hopefully we'll talk about in succeeding conversations. I mean, there's rate of return, there's legacy, there's what happens to me when I'm after 60. And I'm not necessarily in control of all my functions. What happens when life changes? What happens when life events happen with my kids? Do I want to be in a position to help in some way, in some measured way? Or do I want to just throw my hands up and say, well, you made your bed, now you're gonna lie in it? Well, hopefully I want to pour wisdom into my kids, in my kids' hearts, so that they get this, right? To me, the value of learning to control your financial destiny is not as valuable, is not as great if you don't pass it down to your kids.
Right. Nelson says you should be thinking, because he was trained as a forester, 3 generations.
Yes.
And one of my missions is, especially and all my clients aren't this, but I'm just going to say it in the African-American community, is getting you to think long range. It says in the Bible, a wise man leaves an inheritance for his children's children. So you have to be abundant, but you want to build a legacy of wealth and wisdom, right? Because I've seen people get wealth from death claims and blow $500,000, $800,000 in 2, 3, 4 years and don't have a pot to pee in, and it drives me crazy.
Wealth without wisdom is foolishness. Yep.
So there's so much. So this is going to be at least a bi-weekly series, guys.
And,
Don't put it on
and you know,
YouTube.
the whole subject, just like we're talking about, we're continually practicing amongst ourselves, with our families. We're continually learning better ways to communicate this to others, to our families, to ourselves, the man in the mirror, right? And we want to continually communicate it to others. But the audience has to also realize this is a lifetime effort for you. This is an advanced course on money from which you will never graduate.
Ever.
And you want to continually build on your body of knowledge so that you can help your kids grasp it and have them learn from your previous mistakes. And I always say, don't make the mistakes I made. You make new mistakes.
Right.
Then we'll all learn.
Right.
Okay.
My dad used to say, try stuff, you know. So when I was especially when I got out of school, he said, look, you know, I said, I think I want to go into the insurance business full time. He says, go ahead. You never make money working for somebody else. Just make sure you make money. And he says, when you eat, your whole family eats. So you need to be aggressive and try stuff because you learn by screwing up. And so I had, you know, okay, he was behind me. I actually recruited him into business with me for a minute. And so, but that's the thing, folks. You got to try stuff. It's, you know, leave a legacy of wealth and wisdom. That's what this is all about when you think long range. And it's funny. So you always learn stuff. Like, so I know he's got to go. I have like a 10-minute conversation I need to have when we end this, because I think I'm doing some stuff wrong. And so you're always so no, when I work with people, this is the brain trust behind me, because I never think I know everything. I'm always, hey, can you look at this? Am I missing something? You know, so it's always,
we have a brain trust behind us.
yeah, exactly.
Yep.
And big companies, other smart people. So what happens is there's nothing new under the sun, and you can never know everything. No one person knows everything. So business is a team sport. But you do need to focus on, I was reading this book by, what's the guy's name with the leadership, the pastor. I just bought a book. John Maxwell. And the 15 laws of growth. The first growth is you must have a personal development plan. Like, what are the books you're going to read this year? What are the courses you're going to take? And I look at that. I actually break it down further, because I use a 12-week year, Joe, as my operating system. So I look at, all right, what am I going to get better at this year? But my year is 90 days, right? So every 12 weeks, I want to learn something new, get better, grow an aspect of my business, increase my cash flow, build passive income. And I focus on that. So where most people are thinking annual, I think quarterly. So I lap people because I just give myself more urgency. So that's awesome. You know, you want to learn faster, guys, is my point.
Great. Enjoyed it. Thank you.
Yeah. Thank you, guys. Go out there, make it a fantastic day. And if you want more like this, tune in, share it with your friends. We have a free report called The Value of Liquidity, what we've been talking about, capitalizing